Welcome to the Economic Preparation and Depression channel. I'm your host, Tony. Thank you for joining me on this Wednesday, October 9th, 2024 edition. Please be sure to subscribe to this channel. Preach to me for the latest interpretation of financial news. I appreciate all of you guys' support, and our thoughts and prayers are with those in Western North Carolina, as well as those preparing for Hurricane Milton, to make landfall later on by midnight tonight in Southwest Florida. But right now, we're going to be talking about the Dow Jones. It was up more than 300 points today, as you know, as the Fed minutes and an inflation report come into focus. Oil prices have fallen, boosting investor confidence as we head into almost the fourth quarter of this year. And so things are looking on the up and up. And the Federal Reserve minutes came out at 2 p.m. Eastern Time. They're getting a look at the coming inflation report, further insight into the state of the direction of the economy. And so with oil prices declining, with the Dow Jones spiking up 386 points, and NASDAQ and S&P 500 were up as well, respectively. Oil went down to $72 a barrel. And, tech stocks are still going through their things, as well as Boeing is still going through its thing as the strike continues its downslide. But gold prices fall further with the FOMC meeting minutes that I just talked about earlier taking center stage, according to FXstreet.com. So gold falls below $2,600 here, an ounce here, and silver also not coming along for the ride, going down below $32 per ounce for silver as well. So the downside in gold prices is expected to be limited due to the geopolitical tensions, and investors wait to open FOMC minutes and the U.S. inflation data for September. That should be coming out shortly here in the next couple of hours, or tomorrow possibly, when they would go to that. So Fed officials almost unanimously, with only Michelle Bowman dissenting, voting for a sizable rate cut of 50 basis points or more, as they were more concerned about reviving job growth, with confidence that inflation is on track to get back to their target percentage of 2%. So most of the Federal Reserve officials in the bank, they want a 50-point raises cut for the two cuts that are coming in November and December. However, there was close contention that many others wanted only 25 basis point cut. So we'll see which one wins out here. So, of course, investors are going to pay close attention to the Consumer Price Index that's released on Thursday, tomorrow, like I said. And the core CPI, Consumer Price Index, which excludes food and energy prices, have grown steadily by 3.2%. Now, this is expected to decline in August and continue that decline, but we don't know for sure until the numbers come out, if the numbers are real, if we can believe the numbers. So the inflation may be going down, but job unemployment has been going up in both the private sector and other sectors as well: hospitality, transportation, utilities, retail, you name it. And so despite sunny economic conditions, it's on thehill.com, businesses leaders see clouds on the horizon. What they mean by that is the jobs report. The September jobs report was another upside surprise. We had this great report that many people were not expecting, adding this many jobs last month in September. But business sentiment surveys show that the leaders feel uncertain about where they are in the business cycle, because they want to spend money for capital spending and investment, R&D, research and development, but they're looking at it and they're getting mixed signals here. We're saying if everything is great, then why are we cutting rates 50 basis points last time, and now we're thinking about another 50 basis point rate cut in November? In the jobs report is great. If everything is great, then why we need to do all this? In addition to this, why aren't mortgage rates coming down? Why aren't QE, unlimited QE started again? It has started for the banks, but what about for the individuals? Stimulus checks. Why are we going through all these austerity measures if the economy is doing so good? And businesses recognize that. They're like, well, if I do hire more people, I have to pay them a higher wage now because of what's going on. How I'm going to afford that, plus benefits and everything else. And, the wages are allegedly not keeping up with inflation in the majority of American cities, counties, townships, and municipalities. So this is a dangerous precedent here, and that's why a lot of businesses are taking time. 61% of business leaders expect a recession within 6 months. This is from a survey from PwC, PricewaterhouseCoopers, an increase from 49% in June. The survey found that 68% of executives cited, quote, both an uncertain geopolitical and uncertain macroeconomic environment. In other words, we got a potential wars going on around the world, that the United States and other countries are involved in as well, that is going to cost a lot of money, and that's going to increase. That could increase inflation, either crude oil prices, or just inflation in general. And we also have this uncertain macroeconomic environment right here that they noted, which basically means that we're seeing a lot of job losses, but yet everything is showing up as rosy because we're adding all these jobs supposedly, allegedly, and also people they're saying that they're doctoring up the numbers for the inflation, saying it's not that bad, it's coming down to the target 2%. Well, both can't be true. So that's what a lot of the business leaders are saying, and they're showing that more with this anxiety. Regardless of the political environment we're in now, they're showing this more to cut back on hiring and things of nature. So Market Watch Live, Fed minutes show a substantial majority back to half point cut, as I showed you here. Everything is up. Dow was up 350 points today. S&P 500 up. Everything was up besides gold, oil, and cryptos, I believe. So the thing is that we're going through a situation now where they have to decide whether or not to continue to cut these rates into next year, or to hold off on cuts and wait to see if the job market can recover. And I don't think the job hiring market's going to recover, even though the numbers look doctored up and are good now. But you can see that eventually in the business cycle, what goes up must come down. And we've had the last 13-14 years of up return gains on the S&P 500, the Nasdaq, and also on the we have had gains on the job market. But that's not, either that's going to break or the wages are going to break. The wages that people who are getting jobs are not going to be able to keep pace with the cost of living, specifically housing, food, energy, and transportation costs. And that's going to be the backbreaker for the U.S. Economy. That's going to lead into this recession. I think business leaders are seeing that, and that's why they're taking cautiously by not taking on new capital expenditures or new loans, because they know that eventually this bubble is going to burst. Either one bubble is going to burst, either the credit, housing, or the derivatives, or something, the bond market. Something's going to break, and they're going to say, and it's going to go lead us into a recession. Now, how long that lasts is anybody's guess. Will it be a 2-year recession, a 5-year recession, or even a 10-year recession is anybody's guess. But that's what the majority of the executive business leaders are thinking of when they make these long-term plans. So stay blessed, continue to prepare, and I'll talk to you in the next episode. Thank you for listening. God bless.